Have you ever watched a market and just wondered why some companies seem to absolutely soar when the economy's doing great, while others just kind of stay steady, even when things are bad? Well, it's not random. It really all comes down to this core difference between what we call cyclical and defensive companies. And honestly, once you get this concept, you start to see exactly how the stock market is tied to the real world around us. So let's dive in. All right, so here's the game plan. First, we'll break down the two main types of companies. Then we're going to tackle the tech sector, which is a really interesting case. After that, we'll get into how investors use all this information to make decisions, and then we'll wrap it all up with a super clear side-by-side comparison.
Okay, first things first, let's get the fundamentals down. To really get a feel for the market, you have to realize that pretty much every company falls into one of two major buckets. And what defines them? It's all about how they react to the economy's natural ups and downs.
So on one side, you have cyclical companies. Their performance is basically tied right to the health of the economy. Think of them as selling the want-to-have items. The fun stuff we all buy when we're feeling good about our wallets, but it's also the first stuff we cut back on when we need to save a little cash.
The best way to picture a cyclical company, it's literally like a roller coaster. When the economy is climbing up that big hill, their profits just shoot for the sky. But when the economy takes a nosedive, their profits can plunge just as fast. It's definitely a thrilling ride, but it can be super volatile.
And the examples here just make perfect sense, right? When times are tough, what do? We cancel that vacation. We put off buying that fancy watch. We decide to keep our old car for just one more year, and we definitely postpone building a new house. Because these are all things we choose to buy, these sectors are by definition highly cyclical.
Now, on the complete other side of the coin, we have defensive companies. These are the businesses that sell the essentials, the absolute need-to-have products and services. It doesn't really matter if the economy's in a boom or a bust. Their sales pretty much stay stable.
So if cyclicals are a roller coaster, the perfect analogy for defensive companies is the total opposite. Think of them like an umbrella in a storm. They're not going to give you those same exciting highs, for sure, but they offer that crucial protection and stability when things start to get a little rough out there.
And again, this just clicks when you think about your own daily life. You can't just stop paying your electric bill during a recession, right? People are always going to need to eat, they still get sick and need their medicine, and let's be honest, in today's world, a phone and internet connection are pretty much essential. The demand for this stuff is just constant.
Okay, so we've got these two nice, neat categories, cyclical, defensive. Simple. But what happens when we throw a massive, modern sector like technology into the mix? Where does it fit? Well, as it turns out, it's not quite so black and white.
This really is the big question, isn't it? Is that brand new smartphone a want or is it a need? What about all that software your company relies on to even operate? The answer is kind of both. And that's what makes tech such a fascinating hybrid case.
So here's the deal. Historically, tech has been very cyclical. Think about delaying a new gaming console or a fancy 4K TV when money's tight. Easy decision. But, and this is a big but, over the last decade or so, certain parts of the tech world have become so essential that they actually behave a lot more like those defensive utilities we were talking about. And this table just breaks it down perfectly. Cloud computing, that's become the digital electric bill for almost every modern business. You can't just turn it off. Cybersecurity is like paying for insurance. You simply can't afford not to have it. And all that essential subscription software, well, that's just like paying the rent. It's a fixed cost you have to pay to keep the lights on. These parts of tech are incredibly resilient.
Okay, so we've got the definitions down. We understand the categories. But how does this actually help someone who's investing their money? This is where all that theory turns into real-world practice.
It really comes down to balancing two very different goals. Investing in cyclical stocks is kind of like swinging for a home run in baseball. You're aiming for that high growth, those huge returns. But you also run the risk of striking out if the economy suddenly turns against you. On the other hand, investing in defensive stocks is more like putting money in a savings account. It's all about stability, reliable income, but you're not going to see that explosive growth.
Now, sophisticated investors use a pretty cool strategy called sector rotation. It's a very proactive approach. When they start to see signs of economic growth picking up, they'll actually shift more of their money into those cyclical stocks to capture all that upside. But the moment recession fears start to creep in, they'll rotate back into defensive stocks to protect their money and just, weather the storm.
All right, we have covered a lot of ground. So let's pull all of this together into one simple side-by-side comparison to really make sure these concepts stick.
This table is basically the ultimate cheat sheet. It lays out the contrast so clearly. Cyclicals are all about wants. They have high economic sensitivity, and they come with higher risk for a potentially higher reward. Defensives, on the other hand, are all about the needs. Low sensitivity, super predictable, and lower risk. It's that classic trade-off, really, between growth and stability.
At the end of the day, the biggest takeaway here is balance. A really effective investment strategy isn't about picking one or the other. It's about knowing how to blend the awesome growth potential of cyclical stocks with the rock-solid stability you get from defensive ones.
And that leaves us with one final question for you to think about. When it comes to your own personal financial goals, what really matters more? Is it the thrill of riding that economic wave to maybe reach new heights? Or is it the security of knowing you can weather any storm that might come your way? The answer to that is going to shape your entire approach to the market.